All right. Hi, everyone. Welcome to this timing research special event. It's a huge market opportunity webinar with Serge Berger of TheSteadyTrader.com. And just a reminder, of course, this is for educational purposes only. Trading is not suitable for all people. So please only trade with money you can afford to lose. And the session will be recorded and will be available on TimingResearch.com as soon as I can get it posted after the event. And so I'm going to go ahead and turn it over to Serge.
Cool. Thank you, David. I much appreciate it. And I want to thank you and the timing research community for allowing us to talk to you guys a little bit today. Um, I'm going to just quickly show. I mean, this is right now. This is the future of the S&P. This could be the SPY. It's the same exact thing. Um, but if you guys can see this, and I'll make this much more clear in a minute. But just so you know, right now, we this morning as we came out of the gate, we got an overbought signal, and the S&P hasn't been able to make any headway since. So I'll show you guys how this stuff works, and more specifically how you might be able to take advantage of this as well in your trading and investing activities. But before we get to this stuff, I mean, just keep in mind, it's the end of the quarter. It's the end of the first half. We have one more trading day tomorrow. And after that, we go into a 4th of July week. However, it's going to be busy. We've got plenty of data, plenty of stuff happening. So I think it might be a bit dangerous to be too complacent here for the time being. And once these quarter end, first half end flows dissipate, which I expect them to do here in the coming days, I think things could be a lot more difficult for people just being basically 100% long equities. But we will find out. What I'm here for today is to show you one of our favorite things to do, and that is essentially taking advantage of extreme overbought or extreme oversold conditions in the markets. And so, as David said, and again, thank you for you and the community for hosting us here today. As he said, one of the things that I think is important is that this is an educational thing here today. We're not giving you any investment or financial advice. And what I believe in is risk-adjusted strategies, which allow us to just give us higher probability of more consistent profits. That's our goal. This is my risk disclaimer. David already gave his, which I much appreciate. Again, much like David said, trading and investing carries a lot of risk. So make sure you don't ever trade or invest with more money that you can afford to lose, and take it serious. Educate yourself. FOMO and fear are real things, and they can lead us to make silly decisions. But that's one of the things that we really are all about, is making sure we can keep those emotions at bay. This is your truly Serge Berger, father trader, portfolio manager. It says here, that's what my team wanted me to put here. But in all seriousness, that as a portfolio manager, it just it's a very time-consuming job. But I think as an individual investor at home, putting on a few trades and kind of taking advantage of market opportunities doesn't need that much time, unless one, of course, is managing one's entire net worth. So what I'm going to show you today is something that we developed while a long time ago at this point. Gosh, it's probably like 18 years ago or even more. And what we like to consider this to be is essentially a supplemental income strategy tool, actually. We like to use it on equities, ETFs, and of course, thus options and futures, which are just derivatives of those. And it all started at JP Morgan. I was working at JP Morgan at the time, and as a side project outside of working hours, outside of the offices of JP Morgan, just to be very clear, I don't even think we stole a property. We had a little side project going on, and we were working on this project, a couple of managing directors and I, and what I'll show you here is kind of what we came out with. And basically, what it comes down to is we were at the time looking at the markets through what we were doing, which was credit default swaps. Don't know if anyone knows what that is, but they're basically derivatives in the bond market. Let's put it that way. And what we decided to do is figure out when is in our case, a credit default swap, or let's call it a bond or bond protection, extremely overbought or extremely oversold. And we didn't just look for a little bit overbought, oversold, but like crazy amounts, right? Where the odds become huge in terms of a hopefully profitable trading opportunity. And so once I left JP Morgan and moved on to the portfolio manager side, once I left the investment banking side, I started playing with this and started using it for some of my clients at the time, with equities, with ETFs, and all of that using options. And what I found is that it actually worked even better there. So if you look at this chart here, I'm just going to go through a few charts, and then we have the benefit of the market being open here today as we're talking, so we can look at some live opportunities here in just a little bit. But I just would like to explain to you first what we're doing with this, and again, why I think everyone should consider something like this as well. So you can see a stock here. You can see how it kind of drops vertically ultimately, and then these up arrows, and these up arrows are there to tell us or warn us then that this particular stock is most likely not going to continue to go down at the rate which it has over the ensuing couple of weeks or so after that. And you can see in this case it ended up bouncing. Same thing in this case, the AT&T, a severe slope to the downside, really just gnarly in terms of the sell-off. And our algorithm, our indicator, if you will, essentially is fine-tuned to find when something is really just extraordinarily oversold or extraordinarily overbought, conversely. These are daily charts, but this happens just as well intraday. I was just showing you guys a minute ago how literally just this morning, this worked again on the S&P 500, on the futures, on the QQQ, on the SPY. It's all, all that stuff. And here it got oversold in this particular case, and the S&P mini, and then rallied. This could be the SPY. It's really the same thing. But this here, right, it's just literally this morning. This is a live chart. I hope you guys can see this tick through. So this is just this morning. You see it get overbought and then end up going down. So, once we figured out what the algorithm was, where other investors start to come in and say, okay, enough is enough, it really just became a matter of starting applying this to other markets as well. In this case, you can see a stock or another stock, it got oversold, and then, because it was so oversold, it would bounce again. This is an opportunity where the stock got extremely overbought. And again, not a little bit overbought, but like really just crazy amounts of overbought. And then it would basically go down. Here's another opportunity, Rite Aid. You can see the stock just getting unbelievably overbought, and then it goes down. And so, it's one thing to be able to spot this. It's another to be able to use the right opportunity, the right strategy to actually put on to put on these trades. And so what we decided to do is we decided to look at this through the lens of really stocks and ETFs across the universe of those asset classes. And just quickly, from a very short near-term perspective, this here is the seasonality of the S&P 500. We're just closing out the month of June here, of course, in the next couple of days. But the month of July and August tend to be a little bit choppy. You can see how this could be. We could get a rally, we could get sell-offs. This would suggest an up month in the month of July, but I'm not quite sure we're at the point where that's a high probability, to be quite honest with you. I think we're going to chop back and forth here for the next couple of months or so, as we head towards the elections. And that's actually a great opportunity to take advantage of things that are getting extremely overbought or oversold. And so before we go into the current market, I want to just quickly tell you the story. This is a true story about John. John came to me about, I think, 2 years ago at this point almost, and he had this problem because what happened, check this out. This is his actual P&L, his profit and loss at the top in green. you can see that from January through the middle of June, he made almost $1 million if you look at the y-axis. But then he essentially lost it all in 3 weeks and then actually closed the year down, like actually ended up losing money for the year after being up almost $1 million. And the reason that happened is because he was essentially gambling with short-dated options. And I'm unfortunately currently seeing a lot of people doing that, whether they're buying those options or they are selling them. And a lot of people are not aware that of the actual risks within that because they haven't really been exposed to those risks over quite a long period of time now. The problem is when these risks come about, they end up forcing investors, or in this case, John, to give back, in this case, 6 months worth of gains in a matter of a couple of weeks. And that will happen again. I don't know when that is, and I am not going to speculate on that, but it'll probably happen sooner rather than later, as opposed to, taking another 10 years for that to happen. And so this is the real risk I'm seeing. And so I think it's a great opportunity here to take advantage of what we're about to show you. So let's go ahead and do that. So essentially, when it comes down to the markets, we don't necessarily see crashes ahead. We just see, and of course that can always happen, but that's not a base case for us. We just see essentially lower stock market returns going forward. And so the reason why this is important right now is because I think it's not so much for most investors at home to having to change their entire strategy and reinvent what they do as traders and investors as much as it is to basically make a very simple adjustment. And that adjustment, as you'll see, is like stupid simple, yet really no one's doing it. Or I can't say no one because I don't know for a fact, but very few people do it because they just don't think it's lucrative. But I'll show you in a minute how well that works, particularly if we pair it with our indicator, our algorithm. And I'd like to give all of you guys access to that indicator here once we are done here explaining how it actually works. And so I guess one question I have for you, and I'm not going to turn this into a big like Q&A thing, but I am curious, how many people in here have it as their goal to generate sort of a steadier return? Like, if you're looking for, an income from your portfolio, from the markets, be that on a monthly basis or a quarterly basis or whatever that is, right? Type in a yes into the chat box. Let me know if that's one of your goals. And I say one of your goals because obviously we all want to grow our portfolios as well over time, right? So this is not about only that. But I think a lot of people have that goal, and I see a lot of people or a whole bunch of you typing in yes. And so the reason I'm doing this exercise, I know that's a lot of people's goals. It's actually a very liberating sort of feeling to admit to ourselves that that is one of our goals. What I see, unfortunately, is a lot of people who have those goals, they're being taught strategies that have, quite frankly, almost a 0% chance of reaching that goal. And so here's the reality, and the way we see it, I should say. When you look at the S&P 500 in terms of its monthly distribution, then what we see is some months the S&P might do well, some months it might do badly, and then you have kind of everything in between. But there's really not a lot of rhythm when it comes to month. And so a lot of people use strategies to try to achieve some sort of steady monthly gain. But in reality, because their strategies are highly correlated to the broader risk on markets, like stocks, basically, or to keep it simple, that there's almost no chance of them. In fact, I don't think there's any chance of them achieving that goal. And so what we like to do is we like to kind of flip the odds in our favor by doing something very simple, because what we really don't want to do is fall into this trap of essentially, if you look at the mountaintop here, the sort of the peaks, what a lot of people do is they will, climb up the mountain on one side and really stick to their rules for a whole bunch of trades. And then literally within one or two trades, they give it all up again. And they do that again, right? Climb up that mountain and lose it all within a couple of trades. And that ends up being very frustrating, as I'm sure some of you, if not all of you, have experienced that before. I certainly have, way too many times over the course of my career, until I finally took the bull by its horns and said, listen, I got to change something up. But what it leads to is basically stagnating or losing accounts. And then what that in turn leads to is basically loss of confidence in ourselves, and before you know it, we're basically gambling, right? And we don't want to do that, because that, again, it turns into a mess. So here is what we like to do. And again, this is something that I started working on with John, for example, a couple years ago, because again, he had this huge problem where he made a lot of money over the course of 6 months, almost $1 million. Literally, this is his actual account, and then he lost it in 3 months. And this is going to happen to a lot of people, unfortunately, as things wake up. And so that's an issue, right? So let's take this a step further and see what our solution is to this. This is not one of those things that requires a whole lot of time. I say an hour a week or so. And again, I'm not saying this to kind of sound like this is like super easy peasy and it takes no effort, nothing. I'm just telling you, it doesn't take a lot of time. And our goal really is for this to be something that's most repeatable. Everyone can tell you their strategy is low stress or high probability. I think what's most important here is that it's repeatable. I don't know if you guys have noticed, but repeatability in the markets is probably the most important thing. So if we can do something on a repeatable basis, then it becomes easier to be able to, we get into a rhythm, and that rhythm then ends up sort of reinforcing and making us more comfortable with it, and so on and so forth. So we have an easier time sticking to our actual rules. And so what the concept really comes down to is actually very simple, as I said, yet I see very few people doing it. When you look at this chart, you can see there's a steep rally in this particular stock, and then it goes vertical. At some point, any given stock or ETF or other asset, for that matter, for the most part, will at least temporarily get extremely stretched. And at that point, it really cannot continue to climb for a period of time. In our time period, there is about 2 weeks on average, right? And so that can also happen, like in this case, you can see this is an actual signal that our indicator printed. And again, I'd like to give all of you access to the indicator afterwards. But you can see how the stock rallied very strongly, and then our indicator told us, hey, listen, it's probably done going up. Doesn't mean the stock has to crash or that it's a horrible company. It's just saying, hey, basically the last of the buyers have probably bought or almost done buying. And then the stock will pause and mean revert. And the same thing can happen on the downside. You can have a stock that has a steep slope to the downside, and then it just collapses vertically. And then it gets to a point where there's simply no more sellers left for a period of time. And that's really what we want to take advantage of. So really what we're looking at is steep slopes turning vertical. And really what we're doing is, investor fear or greed reaches extremes at those points. And essentially, when investors are most vulnerable, it pays to essentially take the other side of that. And so I don't know if you guys have noticed, I don't know if anyone how many people in here are using options? Is anyone here using options? Give me a quick ME if you've ever traded an option before. I'm just kind of curious. Yeah, some people have, some people have not. Okay, so and it doesn't matter at all if you've ever used options or not. The point is really what I'm with summarizing this. A lot of people are using a lot of short-dated options right now, and that's working. The problem is when that stops working, people have forgotten what happens then. You don't just lose a little bit of money and just take your stop and go home. People's portfolios blow up. It's as simple as that. And the industry right now is not really teaching that because they know no one wants to listen on this. I take the other side of that. I think people need to know this, because by the time the authorities say, hey, enough is enough, everyone will have blown up their portfolio. So, we're going to do these following 4 steps. Very simply, we're going to look for steep slopes that have gone vertical, and then we're going to put on a trade. So let's have a look at this. So again, the concept here is essentially a steep slope that goes vertical, and then the stock or whatever it is, could be an ETF in question, becomes so overbought that it simply just can't continue to go higher for a period of time, right? That's what we're looking for. And so you can see, for example, here on this next chart here, let me just quickly show you this. Like it was Facebook at the time, now it's called Meta, of course. You can see that at the time there, when this stock, every time it shot higher and it went vertical, you can see what ended up happening to the stock. Every time it would go vertical, what the stock would do is ultimately it would get overbought and it would basically mean revert. It basically would pause, is I guess the best way of putting it. And that pausing is really our opportunity to make some money. And so I can show you this here when we go into a live chart, which I'm going to show you here in just a second. Right now here, let me just quickly bring you over the actual chart so I can draw on this. Give me just 1 second. I'm going to bring it over from the other side here. So here's what we're looking at. We're looking at, this is the same chart I showed you, but on this one here, I can oopsie. What did I just do? On this one, I can draw on. So 1 second, I think I just collapsed my thingy here. There you go. Okay. And so what I want to show you here is this. This is the same chart that I showed you a second ago, but let me quickly share with you what that looks like in terms of the opportunity that we get. So I'll bring this over. Here you go. All right. So now what you have here is a chart of Meta at the time, and you can see it was moving up within this orderly, I guess, ascent. And every time it would get either to the top of the channel or if it would blow a little bit higher, it ultimately would mean revert because it would get so overbought that it simply just can't go higher for a period of time, right? It's just a couple of weeks. And this works intraday as well. I'll show you guys the intraday version of it as well. But let's take, for example, this point in time right there, which is where we put on the strategy. Again, this is a historical example just to teach you and show you how this works. And then we're going to go into the current market so you can see that I'm not just making stuff up. Well, at any given point in time, and I'm sure everyone here has noticed that, let's take this point in time here, a stock or an ETF or whatever it is can go higher, right? But it could also just go sideways, or of course it can go down. And so let's say I get to a point here where once again, the stock here has significantly rallied to the upper end of that move. And then we get to a decision point where we say, okay, well, if I think the stock is overbought here, I might take some profits. Or what I could also do if I wanted to be more aggressive, and if I thought the stock would go down, I could buy a put, or I could buy a put spread. Well, the thing is, if I buy a put here or I short the stock must go down. Just like up here, if for some reason I thought the stock would go higher, if I buy a call or if I buy the stock, it has to go higher in order for me to make money if I do that. But what if I were to tell you that there's a way to do this in which I don't have to be correct very much in order for me to make money, period. And so what we like to do is we simply like to say, you know what? We're going to make a bet of where the stock is most likely not going to go over the next 1 to 2 weeks or so. And so in this particular instance, the bet that we made after the stock got extremely overbought up here was that, you know what, we don't really know whether the stock is going to go sideways or lower or even maybe a little bit higher. But we think after it's gone so vertical and had such a big move and our indicator told us it's overbought, we just don't think it's going to rally another 8% against us after having reached that point. And so the way we can take advantage of this is by simply saying, you know what? As long as the stock stays below this line, I can make money. Meaning if the stock goes down, I make money. If the stock goes sideways, I make money. And even if the stock goes up against me, in this case up to 8%, I could still make money. And so what we typically do, though, is we don't just sell a call option. We simply do this on a hedged basis. So we buy another call against it a little bit higher. So in this case, what we would do is if you look on the right-hand side here, we sold an option at the 125 strike, and then we bought one at the 130 level. And so what ends up happening is we actually get a credit for this trade, meaning because the option that we sell here gives us more money in our pocket than it costs us to buy the other option up here, we receive money up front. In this case, if you look over here, we actually received $1 up front per contract, which means $100 per contract. If I would have done this with 10 options contracts, we would have received $1,000 deposited in our broker account up front as I open up the trade. And so the only bet that we're making is not so much that the stock has to go in one direction or another. It's more that we think it's not going to go up here. In this case, as you can see, the stock did actually go down. And I will show you examples in a minute where that didn't happen and we made just as much money. But in this case, it did go down. So for illustration purposes, and what that meant is that we ended up basically what's called buying back that spread for only 24 cents. So we received, let's call it $100, which is what it is. We were then able to close the trade for just 24. So we were pocketing the difference. The difference was $760 with 10 contracts, right, of profits, or $76 per contract. But again, the crazy thing is the stock does not have to go down for me to make money. It could also go sideways or even go higher to a good degree. Can I just quickly check in? Does that make sense so far? Because we're getting to the really, really good point or important point, and then we're going to move into the indicator here in just a couple of minutes. So far, so good. Now, what makes this different than what I see being taught out there and what I see people doing is you may want to notice what the options are that we're using. So at the time we did this trade, and again, we're going to go into the live market here in a minute. I just want to show you the concept first. What we do is we don't use options that expire anytime soon, because that's typically where all the losses are. So at the time we put that trade on, it was the month of February, right? And so we used options at the time in February that don't expire in February, not even March, but in April. And what that does is it allows us to have a much better risk management process. Because if I use a short-dated option, and again, I realize that a lot of people right now listening right now are saying, oh, I use short-dated option, it works well. The problem with short-dated options is it works until it doesn't. And then at some point it stops working. And those people will give up gains that took them, honestly, probably years to accumulate in a very short period of time. And it will happen again. The FTC is even aware of that, and they know that's going to happen again at some point. And I just don't want that to be taking place for anyone here. So my solution to that is to, in this case, we used April options in February, but, and even equally important, we don't hold these trades for very long. We only hold them for a couple of weeks. So by using options that expire between sort of 55 and 85 days out in the future, but only holding those trades for a couple of weeks, we forego a lot of that problem. We also will never hold any trades through earnings, for example, right? Or like if it's an ETF, through something that's very sensitive to that ETF. So that's another way of sidestepping. But the big thing here is not using very short-dated options. So I don't use options for this inside of 55 to 60 days. So between 55 and 85 days or so roughly. Because if I use a short-dated option and trade goes against me, ultimately I'm toast. If I use this with options expiring much further out and I only hold the trade for 2 weeks, at most I basically get a flat tire, right? That's a far stretch from losing 2 or 3 wheels on the highway going 85 miles an hour, which is basically what people are doing with short-dated options. And again, if you're using short-dated options and you're listening right now and you're kind of shaking your head and saying Serge's an idiot, fair enough, right? The point is, at some point, this comes back and bites using very short-dated options. And I can tell you this empirically, having traded, for 26 years now, professionally and money management, all that stuff. And more importantly, even when at one time I was working at a fund of hedge funds as an analyst early on, and we were analyzing these option selling strategies that a lot of hedge funds are doing. And basically 9 out of 10 that used short-dated option strategies ultimately ended up blowing out. And it's really just a matter of, it's a question of time, not if. that happens again, unfortunately. So I'm hoping this is helping you so far, because let's continue along this. And I'm just going to give you one more example, and then let's just show you how our indicator works. And then I'd like to give as many of you as possible access to it as well. But here is the S&P 500, the SPY ETF. And if you might remember, this was during COVID. This was actually the initial sell-off that we had in February, March of 2020, when the market essentially corrected about 30% over 3 weeks. And so I remember this, if it was yesterday, I walked into the office that morning on March 16th. If you look down here on the bottom left-hand side, on March 16th, walked into the office, and again, the S&P was down 30% in 3 weeks. And I thought, hey, we had our morning meeting, and I said, listen, there's no chance that we're going to buy the S&P here, but we are willing to put on a decision, a trade, where we would make the bet that after a 30% drop in 3 weeks, that the S&P wouldn't drop more than another 20% on top of that over the next 2 weeks or so. And so what we did is we simply used a what's called an options bull put spread. Sounds like a tongue twister. It's the simplest thing in the world. But in March, watch this. So in the month of March, we ended up using options that expire in June. Right? So let me repeat this. In the month of March, we used options that expire in the month of June. Why would we do that? We do that because if we're totally wrong and the S&P drops another 20%, which again is extremely unlikely, then we may get a flat tire, meaning a small loss. We don't blow up everything. And so what ended up happening is on March 16th, 8 days later, March 24th, the S&P 500 was essentially at the same level. It didn't go anywhere. So this was March 24th here. This was the 16th. And so they went nowhere. But somehow we were able to close this trade for a profit of 11.4% in 8 calendar days. How is that possible? Using such short-dated options, such longer-dated options. So the reason this works is because ultimately implied volatility plays a factor here. Where I think there's a lot of risk right now in the market is a lot of people using these time decay strategies. And so time decay strategies they work until they blow up. Whereas something like this, empirically, for us, for me, obviously I'm not allowed to give you guarantees because that wouldn't be compliant. But this kind of stuff typically doesn't blow up in the sense of blowing up, right? So that's that's an important aspect to how this works. So when we look at this and we try to take this a step further, the question, of course, becomes where is the opportune moment to put on these trades? And so this is when I come back to what I mentioned a few minutes ago. This is where we developed at the time when I was working at JP Morgan. We were developing this outside of working hours and not within the JP Morgan perimeters. Just to be clear, this was not stealing any property from them. We just had a little side project. And so what we were doing is we were essentially fine-tuning where does a stock and a commodity, whatever, come so overbought that we have to put on a trade that is just irresistibly good in terms of the reward to risk. And so we developed this indicator. I'll quickly share it with you here just before we go into this a little bit more deeply. I'm flipping around the wrong edges here, but you can see what happens when the stock gets overbought. It typically tends to mean revert down, and vice versa. So let's go into this a bit more closely, because obviously everyone here is wondering, hey, give me some meat, Serge. You're talking about old stuff, old examples. Show me, if this really actually works and how does it work and all that stuff. Good, fair enough. Let's do it, right? So if you guys want to, I'm happy to look at some tickers that you have. I'm just going to go through a bunch here that that just popular tickers that I know people like to watch. So let me do that, and I'll show you. So like for example, and I need to quickly bring my chart over before this gets crazy. Just give me 1 second. I have one too many screens here, and I will share this with you 1 second. All right. Okay, good. All right, so let's start with like Apple. Okay, I'm gonna bring this over here so you guys should hopefully be able to see this now. All right, so what you want to do is you want to look at Apple here over on the right-hand side. And so you can see that Apple, this is a number of days ago, got overbought. Our indicator, it's called the Vertical X Pro, essentially warned us that the stock is getting overbought. It's not telling us the stock's a piece of crap and it's going to go to zero. That's not at all what it's telling us. It's simply telling us that it's highly likely that for the next 1 to 2 weeks or so, most investors that are going to buy this stock have probably bought it. That the momentum is likely starting to slow down, if not totally even reverse, which you'll see in a minute. That happens a lot too. And so you can see, since the stock got overbought on the 12th of June, this stock has gone nowhere. It's just consolidating, right? Now, again, you'll see in a minute, there's a lot of stocks that simply then actually go down quite a bit for a while, and vice versa if they're oversold. But in this case, so what I would do is I don't necessarily have to make this complicated. I will just go in, and as I showed you before, I will sell a call option way up here. And then what I'll do is I'll buy another call option a bit higher. So all I'm going to do is make the bet that the stock stays below this lower line here. And so what that essentially means is that I have a good chance of making money over the next 1 to 2 weeks, as long as the stock just kind of consolidates here. And you'll see in a minute, a lot of times the stocks actually go down in the case of overbought or bounce in the case of oversold, right? GPS, all right, this is a gap. All right, let's see here. Okay, gap 2, overbought. And so same idea here. So since this stock got overbought a couple of weeks ago at this point, the stock is now down about 16%. Sure, I mean, I could have bought a put option there. And listen, I have plenty of clients who do that. Just buy a put or short the stock, whatever. I'm here to tell you that a higher probability trade is to do exactly what I just showed, which is to sell a call option up here. Again, buy another call option a bit higher against it, receive that credit, that money up front in my account, and then just keep it on for 1 to 2 weeks. So if I would have done that in this case, right there in early June, then I would be making money because the stock hasn't gone. I mean, in this case, the stock did actually go down quite a bit, like 16%, but it didn't have to. It could just go sideways or even against me to a pretty good degree. Remember, the stock can technically go all the way up here, and I could still make money. Okay, are you guys following so far? Does it still make sense? Right? Let's continue. Let's just move on. So HPQ, another stock overbought, right? So you can see this one too, a couple of weeks ago. Again, it's doing nothing. It's the stock since then is basically now, I don't know, it's roughly down about 8-9%. And so I would just sell a call up here, buy one against it, and receive that income. The problem, if I use a short dated option, here's the problem. So let's go back to Apple, right? So let's assume instead of doing what I just mentioned before, where we sell this option spread, I would have bought a put option. I would now probably be losing money, right? Or if I did this with very short dated options, I probably wouldn't be profitable. But this is now a profitable trade because of the way we structure it and because we're not using short dated options. I don't know, and you guys can, I would love to hear if anyone here has ever gotten burned by using very short dated options. And when I say very short dated, to me, anything inside of 30 days is very short term. I know that's not what's being taught out there right now because we're in a raging gambling bubble right now. Not a valuation bubble, but a gambling bubble. So people don't want to hear this. But quite frankly, I would rather be honest with you than try to show you something that's going to blow up in everyone's face before too long. It's really about making money. It's not about gambling. So that's kind of the thing, right? So we don't want to use short dated options. That's the long and short of it. That's my main message that I've been now saying for roughly about the past 30 minutes or so. So let's just look at a few more ideas here. Like for example, I don't know, what's a stock that recently just got over, like FedEx, okay? So FedEx got really overbought just the other day, right? And this is I'm using end of day data. So just if you're wondering like, why am I not seeing today, the stock is essentially down 1%. We need to use end of day data because we want to put on we want to put the trade on the day after it basically becomes valid. So like, for example, you can see FedEx here. This is all web-based. So our clients and myself, when I use this, I just click on this button right there where it says TST Pro Scanner, cloud-based. And when I click that, it opens up, okay, great. Opens up this page right here. It's a tab within the browser, right? And so you can see like FedEx, it got extremely overbought yesterday. And you can see it's brand new. It's a brand new signal, 0 days old, means brand new. And I need to wait until I have a day where that error is no longer there. And I think that's going to happen real soon. It looks like someone wrote here that he or she lost 4% of the portfolio in a couple of days. Yeah, listen, that's the problem with short-dated options. Again, people are going to find this out before too long. But right now, again, we're in a bit of a gambling bubble, so people don't want to hear that. But I'm hoping you guys are listening, because I really would like for people to prevent blowing up their retirement accounts, which sadly a lot of people are going to do. Let's look at Target, for example. Let's see here. So TGT. I know this one there you go. So this one had an oversold signal just a few weeks ago. And you can see once it got oversold, the stock ended up bouncing about 9%. Now, the stock really hasn't done a whole lot. But again, we're not needing the stock to do something crazy. When we get an oversold signal, what we do is we sell a put option down here. Notice I'm saying sell, not buy. And then we buy for protection another put option a little bit lower. So basically what happens is as long as the stock stays below this upper line, this line right there, we're able to make money. In this case, the stock ended up rallying like 7 or 8% or 9% within the next few days. And of course, that trade would have been profitable immediately, right? Don't have to wait very long and you can get out. But again, the beauty is the stock could go sideways. We could make money. It could go down here, down here, we could make money. And of course, if it goes higher, we make money as well. So that's the way we look at this. And I'm hoping this is resonating with you. By the way, if anyone's a day trader, I'm going to show you guys how this works intraday as well. But I just want to show you the concept first, because for day trading, we want to use it intraday. Oracle, I think Oracle was just the other day. There you go. So this is Oracle. So Oracle got overbought. And again, the stock's not doing anything. It's just going sideways. It hasn't fallen apart. But then again, we're here at quarter end, month end, first half end. Portfolios are being reshuffled. It's one big choppy mess. So, if I would have bought a put here when it got overbought, I probably would have lost money. But if I would have just sold a call up here and then sold another call a bit higher and just literally wait for the next, wait a couple of weeks, 1 to 2 weeks, I just collect that premium and I move on. If it's a profitable trade, of course. And so for us, it makes it for a much smoother ride in terms of allocating capital from a trading perspective, if we're looking to generate income from the market. I know Starbucks is another one that I took advantage of a few weeks ago. Just so you see here, this stock got very oversold. You can see right there. It was an absolute no-brainer to then just go ahead, sell a put down here, buy a protective put against it. And again, as long as the stock stays above that point, I make money. Now you're saying to yourself, well, Serge, if it's so great, why don't I just buy a call? Again, there's nothing wrong per se of buying a call. The problem is we have a much lower probability of making money by buying a call, because we can only make money if the stock goes up. Does that make sense to everyone? Whereas what we're really wanting to do is we don't just want to make money if it goes up. We also want to be able to make money if it goes sideways or even all the way down here. It gives us a much higher probability of making money. Because if you buy a call here and you say YOLO, right? I'm going to go play golf and put on a YOLO trade. you're essentially, and I'm not saying you as like anyone individually, but one is essentially gambling because I'm making a very short-term bet on timing, directionality, and magnitude of the move. And that's a lot to ask for, to be honest with you, particularly if we're trying to generate, sort of some sort of a positive return on income on this on a more repeatable basis. All right. So that's how we see it. Palo Alto Networks is another one. This got oversold a little while ago. And then you can see what happened. Again, it just screamingly oversold. Again, yes, I could buy a call, but again, if I buy a call and the stock doesn't bounce, I'm toast, right? So why make that gamble in our view when I could just sell a put down here, buy a protective put a bit lower, and as long as the stock just doesn't go down here, meaning if it goes higher, sideways, or lower, I'll make money. It really is as sort of repeatable as that. Let me just quickly check in. Still making sense for everyone? Yeah. So the way we do this, and I'll show you how to do this for day trading as well, because I like to use it for intraday as well. All about intraday, I typically don't do I don't use options spreads. I will typically buy directional trades, which is the only major difference intraday at all. But I'll show you that in just a second. But what's cool about this as well, the way we've got this is we've got it set up so that when I open this in the morning and when our clients use this, we just log into this area right there. And again, I'd like to give all of you guys access to this here in a minute, or anyone who wants to. And we just click on that button and it opens up this tab here, another tab within the browser, and I'll just find opportunities within seconds. So like FedEx, boom, right there. 0 days old means brand new, and you can look at FedEx in its previous signals. So last time FedEx got overbought to this extent was in March, and then the stock basically collapsed about 16%, right? So yes, I could have shorted the stock there, could have bought a put, but the higher probability in our view is to sell that call spread. Same thing here. It's going to be a similar situation. I'm not even thinking FedEx goes down at this point. I think it's just going to consolidate for a little bit. And again, it's not yet ready. It needs to have a day where the arrows are no longer printing, and that's what we're looking for, right? So that's kind of how this works. Now, again, if anyone's a day trader, I want to show you how we look at this from a day trading perspective as well. But here's another one. Like here's AVGO. Can you guys see Broadcom? This one printed 5 days ago. I'm not making this up, right? You guys can all see this. This is Broadcom, AVGO. I think a lot of you guys probably, I know it's an expensive stock in price terms, so not a lot of people actually on the retail side actually trade it. But I mean, you can see the stock got overbought. Finally, it released, and it then basically ended up dropping like 12%, right? So again, yes, I could buy a put, but again, the higher probability is to just put on that spread up here so we can make money whether it goes directionally in our direction, sideways, or even against us to a pretty good degree. Make sense? Oracle we looked at earlier, that's there. That's going sideways. Apple we talked about it. And same thing if stocks get oversold, right? Now, what I can do is in here, I can also create a watch list. I can create my own watch list. So, I can go in here and I can, with like 2 clicks of a button, I'm going to type in blah, 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 create a watch list, right? And then I hit done and it creates a watch list, and I can just drag stocks in there. So let's say I want to add whatever. Let's say I want to add what did we look at here a second ago? FedEx. Let's say I want to add FedEx to my watch list. I'm just going to take it. I'm going to grab it, move it up here, add to my watch list. My watch list is called Sergio because that's my first name. And it's added to the watch list. Boom. And now when I go to my watch list, it's there. So now what happens every morning, I'm going to get an email. Every time this stock gets overbought or oversold, right? This is FedEx. I'm going to get an email, and it's going to tell me, hey, the stock is overbought. Be careful. And I can up here in my avatar, I can just put in my email address and make sure the alerts get sent to me in the morning. So now for day trading, I know there's some people before that said that we're interested in day trading. I just want to quickly share this with you for those people that are interested in that. So for day trading, it's a similar story. Now for day trading, you want to install this on like your Thinkorswim platform or something like that. But like, for example, here, this is Chipotle. We looked at the S&P earlier, but like this was, I think, yesterday or something, CMG, a couple days ago, Chipotle Mexican Grill. And you can see the stock got extremely oversold right there. And so when that happens, now this is an intraday 5-minute chart. For day trading, I personally like to use 5-minute intraday charts. That's what I like to do. I like to do 5-minute intraday charts intraday. Now intraday, I don't do credit spreads. I will simply buy the stock, or in this case, we'll just buy the call. I like in this case, and I would use a near dated option, like 2 to 3 weeks out, even though it's just a 60-minute trade. And I'll just keep it on, and I basically set a timer for 60 minutes. And in this case, you can see the stock went up like 4 or 5% pretty quickly. So, same thing with the indices. So if I want to, I showed you earlier the S&P 500, the SPY or the futures or whatever. It's the same rhythm, and it's the same algorithm too. So whether I use it for day trading or whether I use it for on the chart here on our cloud-based version on the daily charts, it really doesn't matter. It's the same. It's the same rhythm, right? It's the same algorithm, I should say, as well. And I think that's, I think that's important because again, we want to use repeatability. We don't want to make this more complicated than it needs to be. We want to make this as simple as possible. Now, if you're asking yourself, hey, what if I only care about a certain sector? What you can do is you can go in here and click on sectors, and then you can click on, let's say you care about the energy sector, right? Or let's say you could also do it like this, and let's say you only care about, I don't know, what do you guys care about? Financials, right? Or you can go to even more granular. You can go in here and say, okay, I only care about, let's see, oh, sorry, here. Let's say you only care about financials, right? But it's not just financials. I only care about insurance companies, right? And then you can check, okay, all insurance companies got it, and it's going to show you the insurance companies that are giving you opportunities, overbought or oversold. Make sense? It's pretty straightforward, right? It's not a hard concept to do. So, as I said before, I'd like to give everyone here that is interested in lifetime access to this. And so here's how it works. As you guys have seen, this is a very repeatable process. And I like the word repeatability because repeatability means we can make something almost second nature. Meaning we become really good at sticking to the rules. And so that's really what this is all about. So the options income secrets package here, which is composed of the indicator, lifetime access, and a ton of other stuff, is really built for that. It's for the repeatability. It's for income. I even give you a cheat sheet and webinars and everything to make sure this is something that you can use. It becomes a little bit easier to do every single day, maybe even every hour, until it basically becomes second nature. And so we created and crafted this indicator in this package. And again, I'd like to give all of you guys access here that would like to do so. We even created the cloud-based version I showed you before, the browser-based version, but also a version that you can install on one of your platforms, be that Thinkorswim or TradingView, or I think we have a couple other ones, NinjaTrader and a couple of other ones as well. And I'll show you that in a minute. But I think the most important thing here, again, is the repeatability. And so if you want to, let's say, day trade with this, or you just like to install this just for the fun of it, you can do so on Thinkorswim. You can use it on things like NinjaTrader or TradingView.com. It's available on Wealth Charts as well and Metastock, great partners of ours, both there as well. So it's available in a whole bunch of different platforms, but particularly if you want to day trade with it, you'll want to use the install version. You'll want to install it on one of these platforms. If you want to use it for the income, for the spreads I just explained to you for the past 50 minutes or so, you do not need to install anything. You can use the cloud-based version for that, which is this thing here that I showed you here just a second ago, right? So the first thing typically people do when they come on board and they start using this, they basically create their portfolio. They basically replicate their portfolio in here. which allows them to then be able to follow all their stocks and see when they become when a signal triggers. There's our friend John again. So, to me, what it really comes down to is this to us gives us the highest probability in our view income trades, supplemental income, however, whatever the term is we want to use. I can give you a bazillion testimonials. I feel that always sounds a bit weird, but like Guy wrote to us. He said, for anyone sitting on the fence buying this, I've had this package for a few years and I can say it's worth every penny. And whatever. The only thing I would say, I think if people that are listening right now are in the markets mostly for fun, this is probably not something that you'll care about, because then you're more in the market for the thrill. And I think thrill seekers are probably better not using this, because again, it's about being serious and looking to generate an income on a repeatable basis. That's our goal. So I think what really it comes down to is this: if you can see yourself using something less, we're gonna knock 50% off here right now for 50 people. So anyone that wants to join here today should be able to get this opportunity. And basically, the way it works is this: the regular price is $7.97. We're gonna give you lifetime access, and I mean lifetime. There's no hidden fees, nothing sneaky, monthly, quarterly, whatever, for just $3.97. That's the indicator for life, both the install version and the cloud-based version. That is an options trading course series. Our member webinars we do twice a month with trade alerts. I'll talk about that in a minute. We even have an Iron Condors course. And again, all that's available for the first 50 people. Now, there's a link down here, and I don't know if you guys can see this. It's studytradersecrets.com/timing. It's right at the bottom of the screen. And thank you, David, for putting that in. If you want to call someone, our relationship managers are also there if you want to talk to them. If you want to use PayPal, you can do that as well. In other words, PayPal, I think, even allows you to finance this. That's not us, that's PayPal. So, like the $3.97, again, it's literally half price for lifetime right now. But if you want to do that, you can just use PayPal. Just go to that link, studytradersecrets.com/timing. If you want to call someone on our end and order by phone, or if you have questions or whatever, 401-203-7389 would be the way to do that. And they will be happy to talk to you and address any questions you have. Now, before we come back to this, let me just do a couple things. First of all, again, these are the platforms you can install this on. If you want to install, you don't have to install it. You can use our cloud-based version, which is award-winning. So you don't need to do, but if you do want to install it on one of these platforms, that could be done as well. We have a chat room. The chat room is in an app. The app is called Slack. And if you have a phone, if you have a computer, a laptop, a tablet, whatever, you can use this members-only chat room. In this chat room, you don't have to use this. It's our community, and we put in trade ideas there every day. We show you ideas of things getting overbought or oversold, whether it's intraday, like on the 5-minute charts, or on the daily charts, right? That comes from our indicator that I just showed you. So that's a wonderful way of using it as well. And then, very important, as I said before, you want to make sure you join our member webinars. We do these member webinars, and we do them 2 times every single month, like for life. And what we do there is we give you trade alerts. So in these member sessions, they give you these trade ideas every single time. It's just 2 times a month, every single month. They give you specific trades: entry, exit, which trade, which option, blah, 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 all that stuff. And even an intraday idea. And we teach you, of course, how it all works, right? That's also what these sessions are for. So I would highly encourage everyone that is joining here today to join these sessions. Again, they happen twice a month. And so that's that. Again, the phone number 401-203-7389. StudyTraderSecrets.com/timing is the link for that. Again, David was kind enough to put that into the chat box. Quickly back on the chat room. It's really an app, but you can use this on your phone if you have a tablet or PC, laptop, whatever, anywhere. It's just a great way to to stay in in the know with what we're doing in real time with ideas, to converse with us, communicate, whatever, and so that's that. Just quickly, in terms of some of these ideas, when one of these ideas or alerts comes up, like they typically don't have to be executed that very second, right? So like if you find this idea in AVGO, or we give it to you inside one of our member webinars, or we put it in the chat app, like it's not something that has to be executed that second. We're not day trading with this on a daily chart. If it's a day trade, of course, it's a day trade, but then that's a day trade and it has to be done quickly. But for the most part, these are not the kind of things you have to, drop everything you're doing and run to the computer and punch out a trade. So I think that's that's one of the great benefits of this. It's not something that you have to stare at the screen on all day. So we specifically designed it this way, and I hope this is helpful for everyone that is joining us here with this offer. Basically that works. I think it's the offer is good for about an hour right now. I believe that's what it is, and then it basically just shuts down, and then the price goes back to $7.97. So if you want to save 50%, again, it's lifetime. This is not a one-time. It's a one-time. It's not a monthly fee. It's not an annual fee. It's not a quarterly. It's literally just one time, and you are a lifetime member. You own the indicator, the scanner, the cloud-based version, the member webinars, the alerts we give you there, the chat room. It's a fantastic thing. So we would look forward to having you guys on board with all of this. Let me see. I think I've addressed. Let's see here. I think I've addressed all the questions that I can see. Yeah, the last point, just quickly on the intraday stuff, for those people that are looking to day trade with this. Again, the big difference between the way we use it on the daily charts and for day trading is that day trading, I do directional trades. So for example, we go in and we'll just, in this case, buy a call, right? That's typically how we use this. Mason, I don't know about automated strategies. I mean, I can tell you, you can install the indicator on Ninja for sure. That's a fact. But I don't know if you can use automate. I mean, I would imagine you could automate it. I personally, I'm not sure I'd automate this. I just don't see the reason for it, because if we're doing credit spreads, that's kind of against the point. But hey, I mean, obviously, maybe you're figuring something out that I don't know, which is always possible, of course, right? But yeah, I mean, you can use it on NinjaTrader. You can use it on NinjaTrader and on other things at the same time. So you can use it on NinjaTrader and also use the cloud-based version, or you can also use it on Ninja and on Thinkorswim and the cloud-based, right? So you can use it in all sorts of things. Yeah, I mean, okay, sure. I mean, yeah, yeah. Yeah. Oh, for futures. Oh, I use this a lot on futures, like every week, a lot on futures. I use this heavily on futures. I use a 5-minute chart on futures. That's typically what I do. So obviously, yeah, everyone's got their own thing, but I personally like these on futures. I use it on equity futures, so like S&P 500. I like to use it on gold, oil. I still trade a lot of fixed income stuff, so I use it there too. But I just showed you guys futures chart like literally like about 10 times. I'll be happy to show it again. So like I'll show you another one. So like for example, this here is silver futures. Okay, got overbought. This is a 5-minute live chart. Overbought, boom, down. Same thing for the S&P 500 E-mini. There you go. This morning, overbought, boom, down. Right, and this is just right now. I mean, I could show you a bazillion of those. So this is for day trading. Oh yeah, this is now day trading. These are the day trading charts I showed you a second ago. So I basically I like to day trade futures, equities and things with this. When I can, I'm busy managing portfolios during the day, but I typically trade a lot of futures. Or here's the S&P the other day as well. Here, I'll show you this. This is also a 5-minute chart of the S&P 500 here. Futures, the ES, right? Here. And so you can see it gets overbought. And then if I want to, I could short the futures. And then, it should go in that direction. So, yeah. And you can, and this, I happen to use this on Thinkorswim. That's just because we're on the Schwab platform also for our investment advisory firm. But yeah, hope it makes sense, folks. Is that helpful for everyone? And a quick yes if this is has been helpful for you guys to kind of clear things up a little bit and maybe show you some other way of doing things. Cool. All right. Well, listen, David, I don't know if you're still here, but I again want to thank you for the opportunity.
Yeah, I've been watching closely. Excellent presentation. So thank you for being here.
Thank you very much. And all of you guys that are joining, just know that you're going to get a personal onboarding phone call from one of our team members. They're going to make sure that you're up and running properly. And then our next member webinar is next week, actually. Next week, I believe on Wednesday. So we look forward to seeing you guys there for the next opportunities. So cool.
All right. So yeah, unless anyone else has any other questions, that's it for today. If you want to review this presentation, I will have it posted to Timing Research as soon as I can get it processed, and you can be sure to check out the link.
Yeah, perfect. All right, guys, thank you so much, and we'll see you on the inside.
All right. Thanks,
Take
Serge.
care, David. Bye.